Hey everyone, in today's video, we're going to be talking about McDonald's stock here. We're going to be going through their business model and strategies before going into their recent business performance. We're also going to touch on some recent Investor Day slides that they published, which are really interesting in terms of where they see their vision for growth in the future. Then we're just going to wrap it up with me talking about my stake in the company and my thoughts about their current valuation looking forward. So I hope you guys like this video. If you do, be sure to give this video a huge thumbs up. Helps a ton with the YouTube channel and gets more people watching the video. So we're just going to jump right into it here. You can see here in the last year, stock's up about 6%. It's gone through a bit of a jumpy ride here. Went all the way down to $245, back up close to $300 a share. This little crater here was during that whole Ozempic scare where all the fast food stocks, soda stocks got hammered because people thought in the next 5-10 years everyone would be on these weight loss drugs, not eating fast food as much, not craving soda, stuff like that. But it's really rebounded very nicely, back up essentially to all-time highs here in the last 5 years, up 60%. So pretty strong performance, all things considered. In addition to that 60%, you're getting a growing yield here, currently at 2.3%, but they've increased their dividend for 50 plus years on this one. So this 2.3%, maybe 2.5% on shares bought today, and then in 2025, maybe 2.8%, 2026, maybe 3.2%. So it's really powerful from a compounding standpoint for long-term dividend investors, as long as you believe in the future earnings growth and potential of the underlying business here. So let's get into some more information about this company. This is a really interesting just kind of grounding exercise on what their restaurant landscape looks like. You can see over 50% of their restaurants are actually licensed, and they call it conventional licensing, where they own the building, they own the real estate, and they just license the business to a franchisor or franchisee rather, who pays them a percentage of sales as royalty and rent. So that's like a licensing royalty for the rights to obviously use the McDonald's brand, the McDonald's products, all the trade secrets and the know-how. And then they also get paid their rent. And lots of their rent, and this differs from lots of other companies in this space, is paid out as a percentage of sales as well. So whereas maybe making up an example, a Burger King will pay 6-7% in royalty income in terms of a percentage of sales, and then will pay rent to a third-party landlord. For McDonald's, who owns lots of the buildings for their licensees, they get 10% of sales for rent, and then they get another 7-8% of sales as their royalty income. So they're getting like 15, 16, 17 points off the top line that's going straight into their coffers, which is really powerful in terms of just cash productivity and the company being a high margin cash cow. They also have developmental licenses as well here, 20%. On these ones, they don't own the real estate. Lots of these are in other countries where they don't have as strong of a real estate presence as they've kind of built out in the US over the last 70, 80 years. And then they have foreign affiliated partners. And these are markets where, for the most part, they contract the right to license out McDonald's to another company. So in like China, it's a company there, for example, that owns the right to franchise out McDonald's. And then on those businesses, McDonald's is getting still a royalty, but much lower than here because they have another partner that they have to support as well. So that Chinese company probably gets 4 or 5%, and then McDonald's may get 1-2% top line royalty just because there's more mouths to feed there. And then also McDonald's has invested or has cut agreements when they gave these rights over that they actually own a percentage of the company as well. So they're getting a percentage of bottom line earnings in those foreign corporations. Only about 5% of McDonald's restaurants are actually owned by McDonald's, which is really interesting. And they've kind of gone through this process, which you'll see over the last number of years, of pivoting away from this. And I think they like that 5% number. They used to be much higher. Okay, in terms of some of their segments here, we'll go through this quick, but the US market is their biggest segment, most profitable segment, because they kind of own the whole value chain, and they have really strong presence in the market. Then they have international operated markets. These are markets where they operate themselves through primarily licensing. They don't sell the rights for the country to a third party. So this is obviously like the UK, Canada, Germany, France as some examples. And then they have other markets where they have contracts and corporations that do lots of the work for them there, and they just leverage the McDonald's products and offerings and innovation, the marketing, as well as the brand to kind of formulate that partnership. But lots of these companies that operate in these local markets also bring local insights and local tastes and stuff like that to kind of succeed in those markets. Going into how this nets out on a restaurant basis. So the US here, about a third of the total restaurant count, which I think is approaching 40,000 restaurants. 25% of the restaurant counts is in those operated international markets like Canada, France. Then 42% is in international, like foreign markets like China, Brazil, Japan, countries like that. So first of all, very alarming, just not alarming, but very interesting to see over 40%, almost half of the company is not really directly owned or licensed from the McDonald's Corporation. And that's just because this company is growing so fast in Asia. Stores are opening up in China almost every day. So this continues to be the faster growing side of their restaurant count. But you can see, whereas they have 42% of the restaurants, they only have 25% of the system-wide sales. That's because lots of these sales are done in emerging markets, much lower currency versus the US dollar when translated over, and probably less productive as well because they don't have the equity built up yet, maybe local competition, stuff like that. Then that 25% of system-wide sales only turns into 13% of operating income. So almost half the network derives just about 10% of the operating income. Whereas the US stores and the international stores are about 60% of the restaurants, make up 70% of the sales, and they do about 90% of the income. So just interesting to see that. And as they continue to expand in international markets, sure, they'll get more system-wide sales. Sure, they'll grow restaurant count, but it's not falling to the bottom line as quickly as growth in kind of developed markets where they have that direct relationship. In terms of business strength, you can see here the last couple of years, same store or comparable sales, not same store sales, but total market, 6% growth in the US in 22, 8% in 23. So pretty strong there. In the operated licensed markets, 8%, 8%. And then just as we suspected, just based off of the growth rate and the white space in those international development markets, 17% in 22, followed by 11% in 23. So that's where lots of the growth has been coming in disproportionate growth. So take that with what you will. You may like that because it's getting the company more global, more scale, more presence in areas that they're not today. But it's also a lot of focus and reliance on areas of the system that they have a bit less power in, a bit less financial incentive to drive because they're not getting the full royalty from those franchises and stuff like that. Taking a look at their income statement here, which is pretty interesting. I'm just going to go to the bottom. So this is a income statement for the first 9 months of 2023 compared to 2022. So first of all, just in terms of a growth standpoint, they've done really well. Revenues growing 10 to 20% across the board. Income growing 16% here. They are driving EPS growth of 18%. They're lowering share count, went from 740 million. I think they're currently actually at 730. Here it says 731 is at the end of the last quarter. So everything's been going pretty well on that front from a year over year. But what I really want to show is out of the $4 billion of franchise revenue, so this is that royalty income that they're really organizing their business model against. They only had about $625 million of cost, which means that this is 80 to 85% gross margin business as they just get those revenues for not really investing lots of capital in those businesses. They just have the system up and running. They're taking a couple dollars or a couple percentage points off the top, and that's really productive cash that they're generating from their network. On the other side of the coin, that 5% of restaurants they own, they did 2.5 billion of top line sales. It cost them 2.1 billion in operating expenses. So they only made $400 million on that side of the business. So this is obviously a franchising first business model. They also have very strong system presence and disproportionate power because they own lots of the real estate, especially in the US market. So that gives them a ton of power over their franchisees of making sure they make payments, making sure they stay in line. Because not only do they own their trademarks, they own their product pipeline, they own everything else. They also own the underlying real estate. So that gives them just a lot of stake in how things are run, how things are operated, and making sure that franchisees don't kind of go rogue or know that McDonald's at the end of the day can revoke rights and trademarks and stuff like that. And that is one of the point of difference with McDonald's. When you look at Wendy's and some of these other ones, they have similar models where they're trying to franchise more, trying to grow that side of the business so they can grow faster and be more capital light like McDonald's has achieved here. But they don't own the real estate because it's really hard it's kind of like scaling franchises and owning the underlying real estate kind of go against each other, because buying the real estate goes against the capital light model, but McDonald's kind of built that out over decades and decades and decades. So it's kind of a bit of a competitive advantage in terms of how their leases and how their agreements are structured versus competition. Looking just at percentage of franchise restaurants in each of these models, as well as percentage of restaurants with a drive-through. So I found this to be really interesting. I think in the US, they're like 95% with drive-throughs and 90-something% franchised. You can see here in these different markets, somewhere between 70 and 85% in the operating markets that aren't the US are drive-throughs. And then recently you can see the big push to get more franchise restaurants. So it looks like they sold a lot of their restaurants to franchisees, or they just opened a lot of new restaurants in order to achieve that 89% number. I expect that to go closer and closer to the 95% model they have in the US in the coming number of years. Continuing over, this is the international development markets. So you can see 97, 98%. I would have thought this would actually be 100%. So I'm not exactly sure what that 1 or 2% of restaurants are. Maybe they're owned by the corporations that they're partnered with, and they count that as store owned or company owned because they do own a stake in the corporations in these markets. But you can kind of see the percent drive-through on these ones are much lower. Just maybe not as big of a car market, or people like to sit down there. I don't know the insight into that or if that's an opportunity, but I just found that interesting to see. And just back to the franchising model and how they've evolved their business. Just 10 years ago, they were 80% franchised. Now they're 95. So that just goes to show how much they're striving for that franchise income and that royalty income, as opposed to store operations and logistics management and stuff like that. It's just way less capital intensive to not have to invest in updating stores every 6-7 years, signing new leases, stuff like that, buying new real estate. This is just a much more effective model, and I think shareholder friendly model, because it spews out tons of free cash flow with low capex obligations. So a lot of money for dividends, for share buybacks, for other creative things that they're working on. Going into how they are looking at their business here and some of the KPIs that they look at. So compared to 2019, the business on a total sales basis has grown 30%. When you think about how big of a business McDonald's is and how long McDonald's has been in operation, that is a really strong number to achieve over 3-4 years. So looks like fundamentally the business has been doing really well. 90% of restaurant margin dollars are now through franchise margins. So 90% of dollars are coming from, or 90% of those franchised royalties are dropping into margin. So really strong performance there. And that's kind of, once again, what they're striving for, what they really like to see in their business. And then adjusted operating margins, probably a byproduct of that shift more and more into royalty income and franchising, went from 43 to almost 50%. So almost 50% operating margins with relatively low CapEx spend, really profitable underlying business here. Into how they think they're going to grow their store count to 50,000 by 2027 here. So they want to grow 900 stores in the US, 2,000 stores in international other markets or international operating markets, once again, France, Germany, Canada, etc., and then 7,000 in developmental markets. So obviously about 70% of the growth they see is in these international developmental markets like China, like Japan, like Brazil. And those are a bit lower margin for the company since they're not getting as big of the royalty, but it is still where the white space exists globally. And at the end of the day, they want a global presence. They want huge scale. They want to build their equity in other parts of the world as people are moving around. It can still, give them advantages where they do own broader parts of the network. And they still own stakes in lots of these underlying partnerships with that Chinese entity, with that Brazilian entity, and things like that. So still a good business move as long as there's enough demand. And this is just really good news for investors that they think they can go from 40,000 to 50,000 locations, because it just shows that there's tons of appetite for the business, for the model in these countries that are not the US or Western countries necessarily. Going into how they're going to be returning all this cash as they get all this royalty income, as they lower their CapEx. The two areas that they're really focused on returning capital to shareholders are the two obvious areas: dividends, which they've been paying and growing for 50 years, and then share buybacks, which they've really been ramping up lately. This is obviously after they invest back in their business to drive growth. So obviously, in addition to this capital or kind of system-wide expansion that they're planning over the next 3-4 years, they're doing other cool things like opening up a Starbucks and a Dutch Bros competitor, just 10 locations in the US. Not sure if you guys saw that, but that will be under a new name, and doing those little projects just to see where they can capture more growth and more share of wallet in the quick service restaurant space. So that's a fun little project in an area where they're investing because they have surplus capital. But with all the remaining surplus capital, they've really just been paying that dividend, buying back shares. You can see here, this is a big chart, but even if I look at since, let's call it 2013, they've went from a billion shares outstanding to about 730 million. So they bought back about 27% of the company in the last 10 years, which is pretty good when you count that about 2.7% capital return a year of you just owning more and more of the company year in and year out. Pair that with a 2.33% dividend yield. They're giving 5 percentage points back to investors in capital returns every year over the last decade. So how is this company valued? So they did about $10.80 of EPS in 23. If I was to look at their current share price of $290, that would give me a multiple of about 27.5. Next year, they're expected to do $11.44. So that gives me a multiple closer to 25.5. Just to wrap it up, this is definitely an expensive stock in my opinion. Trading for 25 plus price to earnings for a quick service restaurant business is definitely pricey. With that being said, I understand why they're trading ahead of lots of their peers. They are the most productive quick service restaurant chain out there. You hear lots about Burger King and Wendy's kind of battling it out for number 2. That's way below where McDonald's is. So lots of these franchises are not at the brink of shutting down or financial issues. Even if they were to go down 5-10% in sales, they are leaps and bounds ahead of lots of their competition in terms of productivity, profitability for their franchisees and whatnot. So they're really well positioned and in a position of strength, especially in the US and Western markets. They also have a plan to expand their footprint by 25% in the next 3 or 4 years, despite already being the behemoth that they are. And they have a really good track record of dividends, dividend growth, and buying back shares to give you more ownership of the company. So I get why they're trading at 25 times. I just, in my opinion, think it's a bit rich. Looking at some of their competition here, Wendy's trading at 19 times. I think they have a medium-term outlook to get to about $1 a share in not funds from operation, but EPS. So trading closer to 20 times earnings. Quick service restaurant, which owns Burger King, Popeyes, etc. Looking at their stock here, they're at about, I think, $5-ish of EPS as well on the Canadian ticker, so trading at about 20 times earnings as well. So they're trading at about a 20% multiple premium versus lots of their competitors, 25 times versus 20 times, just because of the plan they have, their historical excellence in terms of execution, and their dividend growth history. So that's up to you if you think that is worth paying up for. Historically, it's definitely been the thing to do. You see here over the last 10, 20, 50 years, it's been an amazing stock to own. But I hope you guys got some value out of this video, me going through some of those investor decks and a bit more information about this stock. If you like this kind of content, be sure to give this video a big thumbs up and consider subscribing to the channel for more. Thanks.